SCORE Northeast Wisconsin and WHBY are pleased to bring you Biz Talk, a chance for you to hear from entrepreneurs and professionals as they share their experiences. From starting to sustaining growth, learn the skills needed for your business to be successful. If you miss anything, you can catch the Biz Talk podcast at score.org/Northeast Wisconsin. And now from the Myron Construction Studio, it's Biz Talk on WHBY.
Good morning and welcome to Biz Talk. I'm one of your co-hosts, Terry Finch, and joining me this week is Rick Sens. Rick, welcome.
Thanks, Terry.
This week, we're going to be talking to Kurt Heling, who is a longtime sponsor of the show and the owner of Kurt Heling and Associates. Kurt, welcome to the show.
Hi, guys. Good to be here.
Good morning.
So this week, we get to talk about the One Big Beautiful Bill and all the changes that it's having on the way people do their income taxes. And this one's important for people, one, because it affects your income taxes, but because it's happening with only a few months left before we get into the tax year where you've got to get everything done. So that's what we'll be talking about, some of that and any other topics that come up too. So with that, we're going to get started. And Kurt, can you start with just kind of give us an overview of what happened? What is the Big Beautiful Bill trying to do, and how are things changing?
Well, one of the things that's unusual about this is this is a tax bill that is changing retroactive to January 1st of 25. Most of the time when these changes come into play, it is prospective for the upcoming years. So, for instance, if we were doing it in 25, these rules would come into effect for 2026. That's not the case here. These rules go back, most of them, retroactive January 1st of 2025. So, for instance, we've got things like no tax on tips for restaurant workers, hospitality workers, personal care type people. We've got no tax on overtime for hourly workers in a lot of situations. We've got some other rules with respect to state and local taxes. We've got a $6,000 additional standard deduction per person for people that are 65 and over. So there's a lot of these different things that are coming into play that are all retroactive January 1st as opposed to going forward next year. So that changes your whole tax planning perspective with respect to 2025 and what you're going to have from a federal income tax standpoint.
So have you been starting to meet with clients then and talk through the changes and what it means for them?
Yeah, we actually did a mass email back in September already because we knew this was going to be an unusual year. So we wanted to get the word out early on things that may come up that may affect clients, things that may affect them where they've never really had to worry about tax planning before. You know, for instance, somebody with overtime, that in and of itself didn't necessitate tax planning. Now it does, or tips, for instance. You've also got retirees with different situations coming up because of the $6,000 additional standard deduction that comes into play. One of the big misnomers that came out was there was this misinformation, for lack of a better term, that there wasn't going to be tax on Social Security. Social Security is still taxable, okay? But there is a higher standard deduction for those that are 65 and over, and that helps negate some of the tax on Social Security. Now, like anything, there's income parameters to this, so depending on your income level, you may not get that whole $6,000, for instance. So there's a lot of planning quirks, planning traps that can come into play as we're working with people on this, and so it really changes the maze as far as getting from beginning to end in the tax planning process.
With all the different things that change, some of which we'll talk about today, but when you look at it, is this the most complicated change we've seen?
I don't know if it's the most complicated change we've seen. I mean, 2018, for instance, was a major complicated change because we got away from having personal exemptions. Everything got combined into a much larger standard deduction in that situation. In that situation, there was a cap put on state and local taxes that had never been there before. So each one of these stands on their own. They've all got their own complexity. I mean, you can go back to 1986, for instance, and that whole change, that was a major change at that point in time. So every time these come through, there's major complexities. I don't know. If I had to rank it, I don't know if it's the most complex, but it definitely isn't the least complex either.
Okay. So let's start talking through some of that. I guess generally first, what are the biggest changes you look at and say the things your clients are going to be most concerned about?
There's probably 4 main items that are going to affect our clients that are new. There are also some items that were set to expire that are going to stay in place. And so there's an effect from that standpoint because they're staying in place as opposed to fading away. But the 4 new ones that I think are the big ones. Number 1, no tax on tips. And those are for restaurant workers or hospitality people, people that are in personal care type things, such as your hair salons, your nail people, and some of these estheticians and things like that. So that is for W-2 workers and contractors that are getting tips. You've got to differentiate your regular pay from your tips on there. On the W-2s, there is already a line item for that. The question there is who's going to be responsible for finding out if they are in the correct industry or not. I think that's going to fall on the employer. We don't know that for certain yet. There's no codes for that yet. One of the other big ones is the no tax on overtime. This is another one where there's some caps on how much overtime is going to be excluded from income. And one of the things that people may not understand is with respect to the overtime, it's only on, when you think about overtime, it's that time and a half. It's that half that's going to be excluded. The straight time is still going to be taxable. And I think there's a lot of people that don't understand that differentiation. Our government being what it is, and because these are retroactive to January 1st, the IRS has got to try and catch up with this as far as the forms that are going to be in place. And when you think about this from a W-2 standpoint, they're not going to have a separate line item on the W-2 for this. So you're going to have to go back to your last pay stub, which means people are actually going to have to look at their pay stubs, and most of these are electronic now, so they're going to have to go into their phone or go into their computer, find their pay stub, find the overtime, plug that into some sort of software system if they're doing TurboTax or whatever it might be, plug that in if they're doing their own returns, and hope they get it right and pull the right numbers out. From our perspective as tax preparers, we're not only going to need people's their W-2s, we're going to need their last pay stubs if they're hourly workers to be able to identify how much is overtime. So it's going to complicate the documentation we need from an accounting standpoint. People are going to need to bring in that last pay stub. They're going to say, well, what do you need that for? I never had to bring that before. Well, that's because of the overtime situation. So that's going to be one of the new things that comes into play. Then we're going to have one of the other big things that comes up is this $6,000 additional standard deduction for individuals that are 65 and over. And again, like a lot of these, there are some income limitations on it. Once you start getting over certain income limits, that starts to fade away. So that's going to be a big one. And then the fourth one is what we call SALT, which is state and local taxes. And that had been limited the last 7 years to $10,000. So that what that means is your state withholding from your payroll, state estimates you paid in if you pay quarterlies, state taxes you paid in if you owed with your state tax return, any of those put together along with your real estate taxes for your home used to be limited to $10,000. They raised that to $40,000. Now, why is that a big deal? Because if you have a situation where most people weren't itemizing them with, in the past because of the higher standard deduction, that limit. Now you've got a situation where if those items are high enough and you've got mortgage interest and you've got donation, you might actually start itemizing again where you didn't in the past. So that's a planning thing, and we'll talk a little bit later about a specific situation with that, where we're actually looking at some of the old school planning steps that are coming back into play because of that higher limit.
Okay. So as you look at these changes, is it really just a transition year we're going through, and then it should be pretty straightforward after that, or is there things people are going to have to watch going forward?
Well, it's definitely a transition year, but they're going to have to watch these things going forward also. It's just going to be a matter of the reporting standpoint and employers, for instance, being able to report these things on W-2s, whereas for 2025, they more than likely are not going to have updated W-2 forms to report those things through. So it's a transitional year, but going forward, hopefully it's easier. But like anything, I'm sure there'll be some quirks and bumps along the road.
Okay. So just a little more on the $6,000 standard deduction. Is there an income limit on that too?
There is. So in that situation, those that are 65 and over, if they're single, it starts phasing out at $75,000 and it's completely gone by $150,000. If they're married, it's $150,000. It completely phases out by $250,000. So it's kind of a sliding scale downward. And I may have actually misspoken on the single. It's $75,000 up to $125,000. So by $125,000 for single, $250,000, that's completely gone. So you look at it and go, okay, so how can we lower our income to be able to make use of that? If your income rises, not only do you have rising income, but you have a lower deduction. It's kind of a double whammy. When you think about your income tax, your effective income tax bracket, you might still be in a 22% bracket, but effectively that incremental income might be more like 44% because of the lost deduction.
Okay. So with the SALT change, is that something most people are going to be aware of or need to be aware of, or is that more towards higher income people?
I don't know that's going to be necessarily towards higher income people. Here's a situation where in the past, for instance, you had situations, and in the past, I'm talking pre-2018, you might have people that doubled up on their property taxes every other year, and then the next year they didn't. Well, that might be a situation that comes into play again for some people in order to be able to itemize. You had people who maybe prepaid their state income taxes before the end of the year. The last 7 years, that hasn't been an effective strategy, but now that might be a strategy again. I had a gentleman who had a fairly large capital gain coming up from a property sale. So our recommendation was to pay his state income tax, which was going to be somewhere in the neighborhood of $11,000. Pay that state income tax, it would get him over the standard deduction. He'd get and the additional deduction because he's not up to $40,000 yet with his state and local taxes. But he would get over the standard deduction, so he'd be able to itemize and help offset that capital gain. So that's one of those situations that's coming up now again that we hadn't seen that strategy, for the last 7 years.
Okay, so we're at the point where we're going to take our first break. You're listening to Biz Talk with Score on WHBY, and we'll be right back after these messages.
Welcome back to Biz Talk with Score on WHBY. I'm Rick Sense, along with Terry Pinch this week, and we are talking to Kurt Heling, a longtime sponsor and a real interesting guy to talk to about tax law. And before we get back to that conversation, I just want to take a moment to talk to you about SCORE Northeast Wisconsin. SCORE Northeast Wisconsin, we serve an 18-county area throughout Northeast Wisconsin, plus the county of Menominee in Michigan. We have over 50 volunteers, each an expert in their field, offering entrepreneurs no-cost and confidential mentoring. Those areas of expertise include IT, social media, marketing, cash flow, accounting, strategic planning, workflow, HR, retail best practices, and many, many others. In order to register for a no-cost, confidential mentoring session and to learn more about SCORE Northeast Wisconsin, please visit our website at score.org/Northeast Wisconsin. You can learn more about how the SCORE chapter can assist you with starting and growing your business, and you can complete an application for a mentoring session. Simply complete the online form and submit it to SCORE. Within a few days, a SCORE mentor will be contacting you to set up a meeting. Remember, SCORE is no cost and offers experts who can offer you assistance in many different areas. To get started, please visit our website at score.org/Northeast Wisconsin. And Biz Talk with SCORE brings you expert advice, impactful stories, and real-world insights from experienced entrepreneurs and business leaders. You can get these programs available through your favorite podcatcher, so listen and follow us today. Biz Talk with SCORE. It's available wherever you get your podcasts. So, Kurt, I can't help but be excited about this news because I was on the internet the other night and I see that people are no longer going to have to pay taxes on their Social Security. Is that really true?
That's a half truth. So if you go on, and I just brought it up on the screen here while we were on break, and it came through Bing or Google or one of those search engines, and the AI thing that pops up in the light blue screen pops up, and the first thing it says is no tax on Social Security, big bold letters, for millions of seniors. That's a half truth, because there is still tax on Social Security for the other half of the people, millions of seniors that are collecting Social Security, and really any individual that's collecting Social Security. So, for instance, we talked about this $6,000. This relates back to the $6,000 additional standard deduction per person for each one over 65. So, just picking that apart for a little bit. A retired person, a person that retires at 62, can start collecting Social Security as long as they don't have any other earned income over $23,000, and we could do a whole show just on Social Security. But that's the basic rule. Well, that person collecting Social Security could still end up paying tax on that Social Security, and they're under 65. They don't get that extra $6,000 deduction. So they're in the same boat as they were a year ago. Nothing changed in that situation. On the flip side, you've got some people who, if they're collecting on their IRAs and if they're taking their minimum distributions and they've got Social Security money coming in, they've got some other interest, dividends, capital gains, they're going to be paying on Social Security. They might get that $6,000 deduction, but if their income's high enough from all those other sources, and in addition to their Social Security, they're not going to get that $6,000 deduction either because their income's too high. We talked earlier about those income limitations. So again, that's one situation where, you've got a one sentence that's trying to be a catch-all that really is very much a half truth, because for, I won't say necessarily a majority, but for millions of other seniors that are collecting Social Security, they are going to still be paying tax on their Social Security, and at the same rate that they were before.
So if I'm hearing you correctly, the more legislation that impacts tax law, the more confusing tax law gets, i.e. I should probably not try to do my own taxes. I probably should find an accountant to do that.
Have someone else take a look at it, exactly, because the situation you'll run into is, again, if you're using one of the off-the-shelf programs or one of the downloadable programs and trying to do it yourself, you might look at something like this and then not include your Social Security on your tax return, and in about a year to 18 months, you're going to get a love letter from the IRS saying you didn't report your Social Security, and by the way, here's what the tax on that is. And you're going to walk into the IRS office, and after they frisk you and make you go through the security, which is pretty much like going through the security at the airport these days, you're going to sit down with the person and you're going to say, I didn't think there was any tax on Social Security. And they're going to say, well, yes, there is, and here's why, and here's where it says. And so you're going to run into a lot of that sort of thing with people trying to do it themselves.
So if you don't have an accountant, what's the best way to go and find one?
Well, they can call us. You can go to our website. give us a call, 920-886-2241. If you're serious about looking for someone, I mean, you can go to one of the franchise places. Otherwise, if you're looking for a CPA, you can go to wicpa.com. They'll have a full listing on there. Go through the, CPAs that might be in your area there. Do you need a CPA versus a tax preparer? Depends on your situation. But you want somebody that's got some training and some background, that's for sure.
And if there's any businesses out there that aren't actually seeing an accountant right now, what would you tell them with all these tax changes?
I would say they're flying blind. Business owners, individuals, both would be flying blind.
And I think one of the things you said earlier that people should remember is that normally when these tax changes happen, they come in effect in the following year. This time, most of the changes come to effect this year.
Right, and that's what makes it such an odd year, because I was talking with someone earlier who had kind of started a plan earlier in the year based on the old rules, and now we come to these rules, and it's like, well, yeah, but so it's changing their plan a little bit, and we're trying to tweak it as we go between what they started to do and where we're at as we come towards the end of the year.
Okay. So as you look across all of these changes and where they're going, are you getting more calls now from clients?
We are. We're getting more calls, and a lot of them, I think at this time of the year, are more, I guess I'd call them tire kicker type calls, or a lot of the calls we get from the clients, our existing clients, are specific questions. For instance, the hairstylist who says it is, what about my tips? Are my tips going to be excludable, and how do I break that out? And then you have, people who always try and take things to the extreme and say, well, why don't we just pay everybody in tips then? And take it to the extreme. Well, no, you can't do that. You still have minimum wages you have to do and everything else. So, there's always going to be people that try and take things to the extreme, and that's where things can get wound up in a hurry and go off the deep end in a hurry.
Okay. We've reached the point where we're going to take our second break. You're listening to Biz Talk with Score on WHPY, and we're right back. Welcome back to Biz Talk. Thank you for joining us this week. We're talking to Kurt Heling of Heling & Associates CPAs, a longtime sponsor of the show. Before we get back to Kurt, I want to mention an educational update that we've got coming, and it's an interesting one. It's on October 7th, and it's called Scaling Smarter, How Fractional Human Resources can help you with big people challenges. So again, Scaling Smarter, How Fractional HR Resources Help Solve Big People Challenges. And the idea is, when you're too small to have your own HR staff, there are times when it makes sense to get a fractional HR person, meaning that maybe 5% of their time is working with you. There are other areas you can get fractional support. There are some accountants who do it. You can build a partnership with Kurt as an accountant, for example, that do this, but it's one where it's getting more and more complicated on the human resources side. And so this is something you may want to consider. So again, it's on October 7th. If you go to score.org/Northeast Wisconsin and click on the workshops and events, you'll find in the regional options, Scaling Smarter, How Fractional Human Resources Solves Big People Challenges. So think about that. It's as we continue to move into a world with artificial intelligence and all the other things that are complicating business, getting more support in a variety of areas helps. And this is one where to think about on the HR side. All right. So again, that's score.org/Northeast Wisconsin workshops and events. With that, we're going to turn back to Kurt. And Kurt, want to talk now about some of the small business deductions and impacts. I know the qualified business income deduction changed. Can you talk about that a little bit?
Well, qualified business income is something that was set to expire at the end of 2025. And so what this big beautiful bill did was it makes that permanent, at least permanent until the next time they change the rules. So what qualified business income deduction is it's a deduction for small business owners. It's specific to small business owners, and this goes back to the 2018 changes that came into play. At that point in time, they made a flat tax rate for corporations, and they lowered the primary C corporation tax rate to 21%. And so what some of the legislators said, well, that's all fine and dandy for the C corporations, which tend to be your bigger corporations. What are you going to do for the small business owners? So they came up with this qualified business income tax deduction as a tax reduction for the small business owners. So by that, I'm talking about your sole proprietors, your partnerships, and your S corporation owners. And what it amounts to is 20% deduction off of your income. So if your business makes $100,000, and this is after all other expenses, if the bottom line of that tax return says $100,000, you get a $20,000 deduction. Now, there's a couple of quirks to that. For instance, sole proprietors have a couple of things that reduce that $100,000 based on, half their self-employment tax or things like that. The fundamental to remember is that it's 20% reduction of your income. Now, if you had a loss in a previous year, you've got to factor that loss into the current year. So it does turn into a math problem. It does turn into a continuing year-to-year business type thing. Each year doesn't necessarily stand on its own for this. So if you have a loss one year, that loss offsets the current year profit in calculating this income. But it is a very good deduction for small business owners. If that had gone away, that would be a tax increase on small business owners through no fault of their own, basically just because it had expired. Now it's being made permanent. So that's one that, working with all the small business owners we're glad that stayed in place.
Okay. Another one, it can be a topic a lot of people don't know about, but it's bonus depreciation and how that changed, because that really impacts small businesses.
It does. And so give you a little bit of background on this one again too. So depreciation, when you've got equipment, vehicles, anything that is non-real estate, and I'll even get to how it can factor into real estate in a little bit, but you can deduct up to 100% of that business, of that equipment in the first year. Now, there's a couple different ways you can do it. There's also a Section 179 out there which allows you to do it, but there are some limitations on Section 179. For instance, you can't take your Section 179 into a loss. With bonus depreciation, you can take bonus depreciation, create a loss for yourself, even if that makes sense for you. We tend to take our strategy normally is take the Section 179 first before we do the bonus, for a couple of reasons. One is, do we really need to create that loss? But then number two, this is strictly a federal deduction. The state doesn't go along with it. So now you got two sets of books as far as your depreciation goes. But the reason we like the bonus depreciation is because it does give us that flexibility. And I was mentioning earlier with respect to real estate, the core real estate, the core structure of real estate, you've got to depreciate over 39 years, and for residential rental property, 27 and a half years. But there are components to that if you do a cost segregation study that you can carve out, and with those items, you can take the bonus depreciation as well. So that's a situation where if a person buys a building, it's worth their time and money to do the cost segregation study so they can find those components, get the bonus depreciation, and get more bang for their buck up front. And it's really a time value of money type thing. You're getting that deduction up front as opposed to having to wait 39 years and taken out over the course of time. So that was one that was gradually becoming lower and lower. It was going to be 40%. Now it's going to be back up to 100%. Eventually it was going to go away. Now it's going to be made permanent again until the next time they change the rules.
And Kurt, who does those studies if a person wants their property looked at?
We tend to refer those out, and we've got a company that we've got a referral relationship with that has architects and designers on staff. And the reason for that is from the IRS perspective, if we did the cost segregation study, IRS could look at that and say, well, gee, that's a really nice worksheet you got there, but what do you know about the costs and components of a building? So having these architects and designers on someone's staff that they can break those components out and say, this makes up this percentage of this building, and breaking down those costs, and then they can bring that report to us, and then we can take a look at it and say, okay, let's take bonus depreciation on this group of assets or secondary group of assets, whatever it might be. So we tend to refer that out so that you've got somebody with the building background, not necessarily a tax background, doing the study itself.
Okay. So the next one on small business is the immediate expensing of research and development costs. What is that all about?
That one gets pretty complicated. Just to spend a minute on that. So with R&D costs, there was an R&D credit that was out there before, and research and development credits, it sounds like a really good thing, but what it really did is a company that was in a research and development phase would have to capitalize and amortize over a course of years the costs in developing a product. It sounds like a good thing going over the course of time, except for the fact that, you know, you're taking these costs and depreciating or amortizing them over the course of years. You're paying that cost up front. Now you're able to deduct that cost up front. Again, certain parameters, talk to your accountant if you're in an R&D type situation.
Okay. So again, it sounds like we're adding more complexity here, but it is what it is. The one that stands out, and from talking to you earlier, it doesn't sound like it's effective until 2026, but it's one that many small businesses get involved in, and that's 1099, issuing 1099s. And the reporting thresholds are changing for that?
The reporting thresholds are changing for that, and I'll give you a whole background on 1099s. This is one that I'm glad, to a certain degree, isn't getting implemented until next year. So we've got the whole year to get people up to speed on this. 1099s for contractors are to be given out when you've got a contractor who, A, is not incorporated, and B, they provide a service, and C, you pay them over $600, but D, you didn't pay them via credit card. So there's a whole lot that, you know, we're down 4 steps in who gets a 1099 here. So just thinking about that for a second, you've got somebody who's a subcontractor of yours, not an employee. And sometimes you'll hear, well, I'm a 1099 employee. Well, no, you're not. You're either 1099 contractor or you're a W-2 employee. You can't be a 1099 employee. There's no such thing. With respect to an LLC that might be a subcontractor, you've got to get a W-9 form. You should be getting a W-9 form from all your subcontractors if you're in business. But what the W-9 does is it gets the name, address, federal ID number, or social security number, and then especially with respect to LLCs, how is that LLC taxed? Because there's no such thing as an LLC tax return. They're still either sole proprietor, partnership, corporation, or S corp. If they check the corporation or S corp box, you don't need to give them a 1099. Just those partnerships and sole proprietors. So then those are the people that would get it, and that's for services provided over $600. That's the piece that is changing in 2026, is that's going to go up to $2,000, which I don't mind seeing that because there's a lot of people that should be getting 1099s, and there's a lot of things that are going on out there. The threshold is too low for people to keep track of from a practical standpoint. Even if you've got a QuickBooks program or some other type of program, it's hard to keep track of these people. So it broadens that up a little bit. So that's just personal opinion. but raising that threshold makes sense. It's been $600 since the 80s. Things have changed since the 80s. But keep in mind, this is an amount that is for services. So Terry, you and I were talking earlier, somebody that bought a truck and then they turn around and 1099 the person that bought the truck, that they bought the truck from. Truck's hard goods. It's not services. So it's strictly for services. And then the other piece with respect to that is it's whether you pay them with cash or check. If you pay them with credit card, they should be getting a 1099-K form from their credit card processing company that they work through. So you don't give that person a 1099 again by paying them for the payment that was made by credit card, or they're going to get a 1099-K for $600, a 1099-U for $600, and if the IRS looked at it, IRS is going to look at it and think that that person got paid $1,200, when in reality they only got $600. So again, there's 4 different levels. So 1099 forms are due at the end of January. It gets complicated. People think it's super simple. It's just $600. You know, it gets way more complicated than that. So that's one thing that's changing. The threshold is increasing. That'll make life a little bit easier on who needs to get one. But that's, like I said, that 1099s can be a cottage industry in and of themselves.
Okay. The next topic is one that's of great interest to Rick with his portfolio of exotic cars. And so we'll talk about car interest on cars loans.
So interest on cars, this isn't necessarily a business deduction. This goes back to some of the personal deductions we were talking about earlier in the show. But interest on cars can be deductible now. But there's a whole lot of things that have to happen first to make it deductible. Number one, it needs to be a new car bought in 2025 or, going forward. And by new, I mean new, not used, not just new to you. And it can't be coming off a lease or something like that. It needs to be brand new. Number two, the loan needs to be new, and it needs to be a specific car loan. Can't be a home equity loan or anything like that. It's got to be a specific car loan as well. So it's got to be tied to that vehicle. The other thing that needs to happen is even if you meet those 2 criteria, you still need to clear the standard deduction in order to use that interest, or it's going to fall in with your home mortgage interest and your property taxes and your state withholding and donations. If that all doesn't clear, that $30,000 or $33,000 if you're 65 or over, or $45,000 if you're getting that extra $6,000. If it doesn't clear that standard deduction, you're still not getting the actual deduction. So it's one of those things that sounds really good, looks really good, that the politicians say, hey, look what we did for you. But in reality, very few people are going to get to use it.
Okay. So as we look at all the tax changes that have happened with the one big beautiful bill, are there any other ones that stand out to you, Kurt, that you want to mention to people?
Those are really the big ones that we've seen come through. I haven't seen any really quirky ones come through where with a lot of tax rule changes, there's something buried in there that you go, oh, I didn't know they stuck this in there. That doesn't mean that as we go through our own continuing education, something may not pop up that says, where it's like, well, when did they stick this in there? Where did they bury this? But that doesn't mean it may not pop up. But the ones that we talked about are really the highlights of the bill that are going to affect most of our listeners.
Okay. And I guess the one important thing that stands out to me as we talk about this is that these changes just came out, and your CPAs and accountants are just learning about all of them now. They're learning quick. And so interpretations may change or new facts may come out. So it's important to work and talk with your CPA early to understand the impacts.
Yeah, and keep in mind, this got signed July 4th of 2025. We're literally about 90 days into this right now. And so it's one of those situations where the rules come out and you start peeling the onion of, okay, what's all in the rules, what exceptions apply. And then you start going through, okay, how do the rules get implemented? How do we apply the rules? How do we take advantage of the rules so we can help people with this? That's where all the continuing education type things come in. That's where all the strategic planning meetings come in, and tax planning meetings with the clients come into play.
Okay. And so then are you really, for the next 3 or 4 months, are you guys going to have to spend a lot of time on education and learning where things are really changing?
Well, educating ourselves, yes, as far as seminars and continuing education, and then also sitting down with the clients and educating them as well, because there's, as we've talked about throughout the show, there's some misinformation out there, and there's some knowing the basics of the rule, but then not the exceptions of phase outs or anything like that may come into play. So educating the clients is going to be a real focus of ours between now and the end of the year.
Okay. We have reached the point where we're going to take our final break. You're listening to Biz Talk with Score on WHBY, and we'll be right back after these messages. To thank our sponsors and donors, we couldn't present Biz Talk without their generous support. Thank you to Kurt and Heling & Associates. Heling & Associates helps small businesses and individuals not just prepare tax returns, but plan for the future. Heling & Associates, personal connection, positive results. Thank you to Johnson Financial Group. Wherever you are in your life or the life of your business, Johnson Financial Group works to understand your goals and match the banking and wealth services needed to help you complete your mission. Thanks to the Business News for promoting our program in the biweekly business newspaper serving Northeast Wisconsin. The paper contains relevant and useful information about the business community in the region. We would like to recognize the David L. and Rita E. Nelson Fund within the Community Foundation for the Fox Valley region for their generous donation and support of Biz Talk and Score Northeast Wisconsin. And finally, thank you to New North, a regional marketing and economic development corporation, for their promotion of Score. The New North facilitates economic growth and helps people in this region live their best lives. That will turn back to Kurt. And Kurt, could you let our listeners know how they can contact you and Heling Associates?
Well, they can call our office at 920-886-2241, or they can go to our website, helingandassociates.com, Heling and A&D Associates, all spelled out, .com, and they can get a hold of us on our website there, and we've got a template on there where they can request an appointment or anything like that. Also, we've got secure portals on there. When we talk to clients, they can upload information that way securely through the fileship program. So obviously confidentiality is a big deal. We don't want things floating around the internet, so that portal is very, very helpful to us as well.
Okay. And so as we wrap things up, one of the things that became obvious as we talked through all the different changes is just how complex the tax code is. And if I remember right, in 2018, from what Rick told me, Paul Ryan had done something about you're going to be able to do your tax return in a half page. How are we doing on that?
So this is funny because you go back to 2018, and if you ever look at a 2018 tax return, the return itself is only a half page long. You'll have a full sheet of paper, but it'll only be a half a page for the first page of the 1040. It'll be a half a page for the second half because you're supposed to be able to do your return on a postcard. What happened with it, though, is they took a lot of the information that was on the original first couple pages, and they created Schedule 1, Schedule 2, Schedule 3 to go on top of Schedule A, B, C, D, E, F, on down, and then all the other attachment forms that come along. So it really didn't simplify anything back then. And now with this one, we not only have Schedules 1, 2, and 3, we now have a Schedule 1A on top of it. So there, believe it or not, there are preparers out there that actually build by the page, and they have a field day with it. They love this. They think it's the most beautiful thing in the world because the tax return's thicker, they get to charge more. So we've never really done it that way. We still can keep it back on the time that we've got into it. But there are people out there that's their premise for how they file a return is based on the page.
And so I guess over time, there never really has been a time when the code itself has gotten too much simpler, although maybe in the 80s with some of the changes in, but.
Yeah, maybe in the 80s. I was still pretty young yet, so I don't remember what it was before that. I'm not to the point of being in the retired part of SCORE.
Okay, great. And Kurt, thank you very much. It was a very good show, and we really appreciate all the information because there's been an incredible amount of changes and a lot of misperception about those changes too.
Yeah.
So, thank you. And for our listeners, thank you for joining Biz Talk with SCORE. You can find this episode out on our homepage of score.org/Northeast Wisconsin. You'll also find it on all your favorite podcatchers as of next Wednesday. We really do appreciate you listening and look forward to many more shows. We are going through a series of bumps or preemptions due to Badger games, but we're going to wrap those up pretty soon and we'll get all caught up on the shows. But thank you very much, everybody, and listen again next week. Thanks. Bye.